I think the recent years have shown us all that nothing is stable. I mean, we're living in an extreme volatile environment that obviously affects funding rates at the banks, appetite for funding rates, and also transaction-wise. Transactions sometimes seem to be more on restructuring side of things. So people seem to look for liquidity, seem to look for bridge financing, and seems to other sorts of financing to kind of have enough, cash at hands in terms of markets or environments who are not stable.
Hi guys, this is Bhavesh here. I'm from Tracxn. We have Steffen with us here, Steffen Bassler from Capstan Capital. Steffen has over 15 years of experience in investment banking as European head at Credit Suisse Strategy Consulting and Asset Management. He actively serves as a board member of Swiss Capital AG, Swiss crypto asset management firm. Before this role, he worked as a consultant in strategy and corporate finance mandates in Swiss industrial finance companies for Arthur D. Little. Amazing. Steffen, we're more than pleasure to have you here on the podcast.
Thanks for having me, Bhavesh. I look forward to our conversation.
Fantastic. So, Steffen, how did you get started? To start with, I mean, how did you get into investment banking industry? Did somebody introduce you, or you were always fascinated towards this industry? I mean, if you can just throw some lights on how did you get started?
Well, I started off quite early with an internship at Deutsche Bank when I was quite young. I then moved on to studying finance and investment banking at the European Business School in Germany, also with some stages across in the US, Canada, and France. And then I started off as a consultant to get a broader perspective of different industries with Arthur D. Little in Switzerland, basically working on strategy projects, mainly with banks, being here in Switzerland. And I then moved over to the client side at Credit Suisse, back then Credit Suisse First Boston, and I was then working basically on the sales side of the prime brokerage desk, serving mainly hedge fund clients, European clients, family offices who look for services investment banking. I then decided to set up my own company back in 2010-11, which is Capstan Capital, to kind of be more involved in client engagements and actually take my knowledge that I learned at a large tier 1 investment bank to my own company.
Amazing. See, Steffen, I mean, you have been in this industry for 20 plus years now, right?
Yes.
You have actually seen 20 different seasons in this industry, right? And back then things were very, very different. It was not technology heavy, right? So we were not very much dependent on technology when we were doing deals or even working on something, right? And things have changed a lot in the last 20 years. So how was it when you were working 20 years back, and what difference do you see now in technology?
Well, I think probably the biggest exogenous factor or crash was back then the Lehman bubble back in 2008-9. I really remember that, being on the trading floor, and we kind of saved a couple of clients who had large exposure to Lehman Brothers. That was really an experience that I will never forget. I mean, being on a Sunday, having a global call with all the directors running the shop at Credit Suisse, and then saying when the markets open up on Monday morning, it will be a huge crash. So that kind of keeps you in memory, so to say. I think the recent years have shown us all that nothing is stable. I mean, we're living in an extreme volatile environment, being it COVID, being it the war in Ukraine, being it now Iran, US, all this stuff that obviously affects funding rates at the banks, appetite for funding rates, and also transaction-wise. Transactions sometimes seem to be more on restructuring side of things. So people seem to look for liquidity, seem to look for bridge financing, and seems to other sorts of financing to kind of have enough cash at hands in terms of markets or environments who are not as stable. So that kind of, but I think every negative side also has some positives. There's people who are now keen to kind of buy add-ons, to buy companies, to acquire, to buy in, probably 5 years down the road, have the opportunity to make some nice profits. So you always make the profit at the entry, not at the exit, basically.
Correct. So at Capstan Capital, if you can just let us know and the audience know what exactly do you do at Capstan Capital? Like, do you do M&A transactions, advisory, and you help companies raise capital? Just let us know about that a bit.
Thanks, of course, Parish. We are basically a boutique mid-market M&A and corporate finance advisory firm. We have 3 offices across Europe. Our head office is in London, and we have an office in Hamburg, Germany, and I run the Swiss office out of Zurich. We advise mainly small and medium enterprises, entrepreneurs who are looking to basically either sell the company, acquire a competitor, or look at the passive side of the balance sheet to refinancing either the equity or some mezzanine loan or some debt financing.
Wow.
We have 20 people altogether in the firm, and I think that's our main focus. We focus on DACH region, German-speaking part mainly, plus UK. That's our main market.
Correct. I think these are the major countries, I think, in the European market where there are a lot of transactions going on. And so are you seeing a lot of old age companies like manufacturing companies, IT services companies, business services companies buying AI companies to implement the AI into their system? Are you seeing those kind of trends happening?
We don't see this just yet. We see a lot of companies, old age companies, let's say insurance companies, who are in a very different business, who are now looking to improve their processes via AI, and seeing here as a first step probably to hire some IT AI firms to give them a little bit of information, basically to educate their senior management at the first point. From my perspective as an M&A advisor, we don't see a huge lot of M&A transaction yet in the AI space.
Okay.
I guess this is partly due to the reason that AI firms here in Europe are probably just at a sense that they want to get more clients and businesses going, and then, but we see, that's basically in a nutshell what it is. Yes.
Got it. And when we talk about capital raising at that part, are we seeing a lot of transactions or deals happening at capital raising to help AI companies raise capital? Because I think AI companies, they don't go for $1 million funding or $2 million funding. So when they go for a funding, they go for a straight away $50 million, $100 million, $200 million, because the kind of data storage that they require, the kind of physical storage asset that they require is very heavy.
Yeah, I mean, obviously, if you look at the companies who provide AI services, in a sense, you're right. They have higher multiples, higher valuations. They go like 10, 15 multiple on a revenue multiple, for example, and then they do raise large amounts. That's true. That's absolutely what we also see. Then on the other side, we see a lot of data centers, hyperscalers, co-location centers. We actually financed the most advanced data center in the northern part of Germany 2 years ago. Water cooled and so on. So we see a lot of transactions going on in that space. That's true. I mean, both on the storage kind of thing, data centers, but also in the service provider kind of things. So that's happening. And I think especially in Germany, you see a lot of movement going on. Germany really wants to become the European data AI center number one. That's at least their goal.
Yeah, and then Germany is obviously, known for manufacturing and its engineering, right? And when you collaborate AI and manufacturing and engineering together, I think it actually blossoms, right? And it actually can make wonders.
Yes, I mean I guess that's the strategy behind it. Plus, I guess they have some homework to do.
Yes, absolutely. And how do you see AI affecting investment banking industry? How do you see your workflow and everything actually changing? Because especially with Claude and ChatGPT into the picture, I'm seeing a lot of work being offloaded to these ChatGPT and Claude to make things easier, and it has actually become easier.
Yeah, I mean, that's an interesting question. I can't give you the full answer just yet, Barish, because I'm still looking what it really affects us. Obviously, the most obvious thing, as we all know, I mean, you can generate, pitch decks, sort of things, relatively easy graphics via AI, even content. But then also what we also see, it only adds up to potentially 90%. I think you still, in a senior partner level, you need to really look into input and output. So you can't just really rely what the machine generates, because I don't think the machines just yet do comprehend what really is needed. They simply try to almost like to dress it all, like the answers, the content is always dressed up nicely. And sometimes we need strong content. So I think it helps. It helps definitely. And I see competitors who are probably not looking to run a huge amount of analyst base any longer and trying to reduce the workforce and replace it with AI. We are a little bit more cautious on that because we still think the human factor is important, especially in investment banking, M&A. At the end of the day, we're working with people who want to sell, who want to increase capital and want refinancing. And you can't just simply outsource everything to machines and AI. I think it's a good help, but I don't think it will replace humans completely.
Correct. But I think it can enhance your productivity in general.
Of course, yes.
I think that's the good way of and the right way of looking at it. Otherwise, you just can't replace people. And how do you? I mean, Stephen, since 2020, we have seen a lot of turbulence, right? Post-COVID era. The market has gone through a lot of cycles, and every year we feel that this year is going to be good. Things are going to change, turn around, right? But somehow something goes on, and something happens, and there's a pandemic or there's some kind of a war going on here and there, right? How do you see the rest of the 2026 shaping and the next year in the investment banking industry with respect to the deals?
Look, I think what we see now, I think when we started off, I think, in a very positive year, then unfortunately this war in Iran broke out, and we had the situation with the oil prices skyrocketing over $100, and everybody thought this is going to be the next global crisis. But I think we've seen that the global economy has become more resilient as many years ago. So, I mean, oil has been rerouted. There have been a lot of oil reserves being taken advantage of. And irrespective of how those peace talks now will end up or play out at the very end, I think we have learned that it will not come to a major crash for the remainder of this year. That's at least our perspective on that one. I mean, we are not microeconomics who kind of predict the future. I believe it's to people who are more educated to do that. But I think what we see now also in terms of deal flows, people coming to us, that's quite positive. So I have a positive stance on that. And I think also on 2027 that we go into 2027 because there is a lot of need for transactions. You look at financial investors who have a lot of companies on their portfolio who want to sell them. So I think that will happen.
Amazing. And Stephen, what is that one piece of advice that you would give to somebody who wants to get into the investment banking industry? Because we are also seeing a lot of surge in the new generation where they are very much inclined towards the finance industry, right? And they really, it looks very glittery. Obviously, investment banking actually looks very good from outside, but there's a lot of work that is involved in it, a lot of numbers that you have to work with. So what is that one piece of advice that you would give them?
Look, number one is don't be scared. It looks very glittering on the outside, but at the very end, it's a very basic job. You have to know your toolbox, you have to know how it works, and it can be learned by basically almost anyone. I think what's important, I think the combination is of really working with companies on the financial side of things, which is quite interesting because, as you said, it's complex, it's challenging, but it's also fulfilling once you have done a deal. Yeah. But on the same token, it's very interesting because you work with people. You work with people who run the company, and I always get asked, so what's your favorite industry? What's your favorite sector? And I say, that's a wrong question. We look at every company individually because every company is as individual as every human being, and it's run different. So we really analyze the company itself, irrespective of the sector. And the combination of people who run the company and the financial aspect of that makes it absolutely interesting and fun to work with. And at the very end, it's very rewarding. And I would give an advice to don't be scared. Just be humble. Go into it. It can be learned. It's not rocket science. It's more complicated than other jobs maybe, but it's also more rewarding than other jobs. But just be humble. Get started. Apply to large firms, smaller firms. Maybe it's sometimes better as a younger person to start with a smaller firm because you get quicker exposure to clients, and you can probably have a much steeper learning curve. So that's probably something I would advise. I did the opposite. I started with a tier 1 investment bank in the beginning. I would probably now do the opposite and start rather with a boutique firm and learn quicker and get more exposure.
Correct. Yeah, because when boutique firms basically get a hands-on experience to every single thing of the deal.
In our firm, for example, juniors get relatively quickly included in client calls, client meetings, exposure, and that's quite interesting. That makes fun that they learn much quicker. And in larger firms, at least what I remember, usually those analysts, they get stuck into a room and do the number crunching and don't get exposure. But it may have changed. It's 20 years ago from my side. But look, that's my advice. I would probably start with a boutique firm in the beginning. That gives you a nice learning curve.
Right. But Stephen, I think in finance, there are two types of finance, right? Two aspects of financing. Like when you are actually working in an accounts or in accounting, you only deal with numbers. But when you're working in a deal, M&A deal or a fundraising deal, then you're not only working with numbers, but you're also working with people, as you mentioned in your right? And dealing with people and matching the expectations or reaching the expectations of your clients is extremely important. So there's a lot of emotional turbulence also that you go through when you're actually trying to value a company or giving the best value to your clients, right? So how do you manage those kind of things? How do you really handle the emotional turbulence of
that's something that can't be really learned. And my wife always says, Steffen, you probably need to be a better psychologist than an investment banker because you're dealing with people. And that's something you learn over time. And you have to be empathy. You have to look at people. And I was always in sales, and I always said, I need to feel the client. I need to know what the client wants. Does the client want a pure transaction? Does the client want a probably more comprehensive advice in terms of also an asset allocation? So it's really, you have to be very empathic, and you have to know that you are serving the client. We are trying to make a deal together, but we are serving the client to make the transaction successful.
Correct. Thank you so much, Stephen. I think this was amazing talking to you. And there's a lot of learning and amazing insights that I've actually got through this conversation.
It was great fun, Babish. Thank you very much for having me, and all the best.